Welcome back. Earnings season is just about wrapped up. All the major companies that are important to this market have all reported earnings, and my companies have all reported earnings at this point. So I always like to just go through and review my holdings, see how I'm feeling about them at their current valuations, check in on their weight in my portfolio, and just see if they beat earnings. For some of these companies, I've already listened to the earnings calls. Some I haven't. Some I still need to go back and listen. But this is the portfolio. At the end of May 2025, around $93,000. The all-time performance here is around 38%. If we compare that to the S&P 500, which is my benchmark, in the same time the S&P is up, 31%. So we are outperforming the S&P, but you know, you see that this portfolio started in September-ish 2023. And I would say September through summer of 24 was kind of wasted. I've been in the market for 5 years, but never really had any real money to invest until, late 2023. So that's kind of when I started. And this period was kind of wasted because, I had no real strategy. I was just it was a random basket of stocks and I just mostly market performed. In this period, since 23, is when I really started to refine my strategy, increase my knowledge, learn from the best investors in the world, read a bunch of books, and so on. So from July-ish is kind of, if we look at a 1 year, 33%, almost 34% up in the past year, and that's start of June. So when I look at my portfolio and kind of compare it to my benchmark, the S&P 500, I look at a 1 year or a year to date. And on a 1 year, we're up 34% versus the S&P at 12.4%. Year to date, the S&P is down slightly still. My portfolio year to date, we're up 15%. So I've been pretty fortunate with my stock picks. And if I had to attribute that to a certain, characteristic of my portfolio is that I value valuation essentially. I'm not chasing the hot stocks. I want to make sure I get the most value for my money when I buy my companies. And I think that's what has contributed to a lot of this outperformance. So with that said, let's look at the actual holdings. So I run a very concentrated portfolio. 4 companies make up half of my portfolio. AMD sitting at a 22% weighting almost. Elf Beauty, run up recently, sitting at almost a 14% weighting. Amazon 10%, and Cheesecake Factory at 8%. The rest are, good quality companies, just not as big. If we look at the actual gain and loss for each holding, I'm currently negative on one, AMD, which is my biggest holding. And, it hasn't worked out yet. I have no doubt that it will work out, in the next year, hopefully. If it doesn't work out in the next year, no big deal. I think AMD's time will come. But, when you look at the gains of my portfolio, thinking that a quarter of it, AMD is really holding it down. What would the performance have been if AMD already made its move? It would have been, pretty crazy. Okay, moving on to each individual holding. Starting with AMD, currently they have a forward PE of 26, which for that company, the future growth that they can expect, the data center side of the business is absolutely exploding. 26 is still very cheap, and as I said, I expect AMD to make a massive move in the next year, and that's why it's 21.7% of my portfolio, as you can see right here. As for the earnings that they just reported, they beat revenue by 4.4%, which represents a 36% year-over-year growth in revenue. They beat EPS by 1.69%. So overall, with the quarter, I'm happy. The business is going in the right direction, even though the stock isn't. Um, you know, I'm hoping that will turn around soon. But yeah, overall happy with that one. Next one is Elf. I've talked about Elf a lot on this channel, made a lot of videos about it. Um, Back in January, the peak tariff uncertainty, I don't know, it was just so clear, based on what the company was saying and just understanding the pricing of their products. Elf already had, I should start with, they make most of their products in China, right? So people thought that Elf was going to get hurt significantly. One, they've been through tariffs for once in Trump's first term. So this is the second time they're going through tariffs. Back in, 2 quarters ago in their earnings call, they highlighted their tariff playbook, what they're going to do to mitigate some of those tariff impacts on their business and keep up their margins and so on. And that was, talk with, negotiate with their suppliers and distribution and raise their prices because Elf's product pricing compared to some of the other cosmetics giants is nothing. And like they can go up 50 cents, a dollar on their products without anyone really noticing. So that way, even if they were hurt by tariffs, they can keep up their margins, right? Um, so Elf, the growth there, 30% revenue growth, eating up market share in this industry. They're trading at a forward PE of under 20 at one point. So I don't know, it was just so clear that this is an amazing business. This has been one of the best companies in the market in the past 3-4 years. Um, so I was buying up shares. I was willing to take that risk. After the recent move, I think I'm up like 45% on this position. It's moved up to a 13.6% weighting in my portfolio. Their earnings, they missed their revenue expectations by 6%, but that still represented a 31% year-over-year increase, and that's coming off some incredible numbers last year. Keep in mind the cosmetics industry has not been the greatest, and a lot of those companies like Estee Lauder have, they're not even able to grow their revenues. EPS, they beat estimates by 6.85%. The big news this quarter was that they acquired Rhode, which is the Hailey Bieber skincare brand. I really like that Elf is moving more into skincare and not just cosmetics because, I mean, if you just look around, the hype around skincare for females and males now too, like I think it's going to be a rapidly growing segment of that market. So I'm happy to see them moving into that. Even at this valuation, a forward P of 31, I still think they're undervalued based on the growth numbers that they can put up. It's, yeah, it's nothing. But moving on, Amazon, forward P of 33, current weight 10% of the portfolio. They beat revenue by 0.33%, not much, but that represents a 8.6% year-over-year revenue growth. EPS beat by 16%. The thing with Amazon, um, their numbers are just getting so large at this point that the year-over-year revenue growth kind of, you know, it just kind of tapers off. The growth number gets lower and lower. So I have a feeling investors are thinking that Amazon's growth days are over. Now, I think Amazon will grow for decades to come, and they kind of have that on lock. That's why I'm very confident holding this position for a very long time. But the thing with Amazon, the past 5-10 years, they've invested so heavily in their business and kind of, I mean, nothing has gone to the bottom line. Their earnings have stayed so low, right? Um, Once they finally stop investing in distribution centers and planes and trucks and all that, stop investing so heavily in AI or maybe slow that down, and they turn on the earnings machine, the profit machine, it wouldn't surprise me if all along, Amazon was actually the cheapest uh, of the Magnificent Seven, because I think they have so much earnings power and potential if they just let more of that dollar go to the bottom line. So, yeah. And even at this valuation, this is one of the lowest valuations we've ever seen Amazon at. So, any opportunity I get, I'll keep buying Amazon for years and years and years to come. Cheesecake Factory, currently sitting at a forward P of 15. This position, I believe I'm up close to like 35, 40% maybe. Um, I was buying this company when the forward P was like 12. They're up to an 8% weight in the portfolio. They beat revenue, beat EPS. Revenue year over year growth 4%. Not fantastic, but I expect that to increase in the coming years with their new restaurant concepts, North Italia and Flower Child. I've tried both of them. I'm very impressed. I think it fits the market very well. When you think about the next generation of restaurants, we're moving away from the Olive Gardens and the Red Lobsters and that crap into something more modern, exciting, like North Italia, Flower Child, pretty well priced. Those places are absolutely packed every time I walk by. So, low valuation on this one. I expect them to grow very nicely, pay a good dividend. I love Cheesecake Factory. Yeah. Uber, next one. Forward P of 30. They've run up a little bit recently. I was buying this around $60 at the start of the year. Now they're sitting around between 80 and 90. It's an 8% roughly weight in the portfolio. They missed revenue estimates, which the market didn't really like. Now, it was still a 13.8% year over year growth, but they beat EPS by 6.3 or 63%. And Uber right now, the profitability and the free cash flow explosion is crazy. I think investors are still expecting higher revenue growth. We'll see how the next few quarters go, but I'm still happy holding. I have no worries at this point. At the start of the year, there were a lot of worries around Waymo and Tesla's robotaxi. But, I was comfortable buying, knowing that there are going to be so many different players. There's going to be Waymo, there's going to be Tesla, there's going to be Cruise, there's going to be Zoox from Amazon, there's going to be, a bunch of different autonomous vehicle providers. One of them is bound to tap into Uber's huge network of users and kind of get revenue and profitability as soon as they can. And that's really Uber's moat. So happy holding, I could buy more at this level. I still think they're fair to slightly undervalued at this point. Any drop in the stock, I would love to buy more Uber. PayPal, this is a value play. Forward P of 14. I was buying the stock around $50 to $60. The forward P back then was like 12, 13. It ran all the way up to like 95. I was up 50% on the position or something. And that was like amazing for, a value, low growth stock in a short period of time. Since then, they came down significantly. This was one of my first big concentrated positions in the portfolio. It's currently an 8% weighting. Look at their earnings. They missed revenue estimates by 0.7%. They beat earnings estimates by almost 15%. But as you can see, that revenue growth is super slow right now. And that's because the new CEO came in and said, listen, we're not going to grow just for the sake of growth. We're going to focus on profitable growth. And I mean, investors don't like that. But at such a low valuation, nearly half of the average stock of the S&P 500, I mean, I have a hard time seeing I could ever lose money in this stock. And with the share buyback program they have going, I think they have authorization of like $60 billion. So they're allowed to buy $60 billion worth of stock back over the, coming quarters and years. And the market cap is around $60 billion. So if the price stays at this level, they can buy up their entire company. So there's such a big buyer in that market. And Alex Chris, who came from Intuit, what I'm seeing, what he's talking about, I mean, yeah, it's promising. He's focusing on profitable growth. Back in February, I think, they had this Investor Day presentation, and there he highlights the roadmap of, once they have these contracts figured out for profitable growth, they're going to start focusing on revenue growth again, hoping to get to, mid-single digits next year, high single digits, 27, and potentially to 9, 10%. Well, actually, it's not revenue growth; it's total margin dollar growth. So, but a lot of that it'll be roughly in line with the revenue. So if they can get that to high single digit growth again, revenue, I think there's a lot of upside in this stock. And I just have a hard time seeing myself losing any money in this stock. So I'm happy to hold. And as I said, I value valuation in my portfolio. It's not the most exciting stock. And sometimes I think like, why am I in this when I could be in something like, I don't know, Amazon or Salesforce or ASML. But, you know, I remind myself that I value valuation. And yeah, this is a good holding in my opinion. Next up is SoFi. 4P of 41 on this. 7.5% weight in the portfolio. They missed revenue expectations a little bit, but that was still 20% year over year growth. And they crushed EPS estimates. They doubled. They came in with 6 cents of EPS when analysts expected 3 cents. So the 4P of 41, the same, just like Elf and Amazon, SoFi is focusing on taking market share and revenue growth. They're advertising a ton, they're investing in their platform and their products. They're not focused on earnings right now. But when they do focus on earnings, I think that PE ratio and that forward PE ratio is going to drop. So in reality, I don't think this company is this expensive. But for a company that's growing revenue 20%, growing members by 30%, taking that much market share, and you got to keep in mind a lot of those members are very young at this point. As they grow up, earn more money, have more money in the bank, SoFi has more money in the bank. They start taking out mortgages and personal loans and business loans. That's more business for SoFi. They'll start inheriting their parents' wealth or their grandparents' wealth who previously banked with JP Morgan or Bank of America or something like that. A lot of that money is going to come to SoFi. So this one's early days, even though I'm up almost 100%, I'm still buying, and I'll continue to buy this one. Especially recently with the change in regulation, allowing these types of corporations to hold and offer crypto products. SoFi wants to get back into that. They offered that in the past. If we look at the Robinhood earnings in the past couple quarters, during a crypto boom cycle, they make so much money from that. SoFi wants to get in on that. So yeah, just happy holding, buying more of this one, any dip I get. Next up is Celsius. So Celsius, obviously, in the start of 2024 ran up incredibly high. And their growth numbers were a little inflated because of the Pepsi distribution deal. Pepsi bought and bought and bought Celsius products and filled up their warehouses. So it seemed like they had all this demand, but it was really just Pepsi filling their warehouses. So the growth numbers were a little inflated. And then one day they said, all right, like we need to work through this inventory. We're not going to buy anything. So those growth rates fell off a cliff. Celsius went from like $100 a share to 21, I think, at the bottom. I mean, it was a crazy drop, and I think it was wildly oversold. At this point, I'm up anywhere between 35 and 40% on this holding. Now, their earnings report was horrible. They missed revenue estimates by 45% and actually declined year over year. Obviously, they're coming off insane comps. So like the last year's numbers were really high and elevated. But they're slowly returning to growth again. They missed EPS by 10%. Now, I do think Celsius is going to return to growth. But I don't think it's going to be anything comparable to what it was or anything as explosive as it was. So at this point, a forward PE of 44 and Celsius being a type of company that Celsius is, like it's not hard to make a sparkling beverage. Now, the marketing side is what really makes them shine. But like a product like that, a drink, it kind of picks up hype and then it's forgotten about next year. So it's just one of those products that like I can't see myself holding for too long of a time. So as Celsius as the valuation rises, I could see myself selling and putting that into, something like a business model that I'm more interested in. And that brings me to this, the watch list that I have called Top Quality. These are the businesses that ultimately I want to be in. Stable, predictable businesses with years and years and years of growth ahead, huge moats. Amazon, ASML, Booking Holding, Salesforce, Equifax, FICO, Intuit, MasterCard, Moody's, Microsoft, S&P Global, Visa. These are the types of top quality companies that I want to be in, and I want to build big, concentrated core positions in. So as the Celsius valuation keeps rising, if I get an opportunity to buy any of these, like I might move some money over to that. Yeah, I just see it as a better business model, stronger business model, like better and more reliable growth, I guess. Going back to the holdings, Shopify is next up. A forward P of 68 on this one, a 6% weighting in the portfolio. If we look at the earnings report, they missed revenue estimates by 6.5%, missed EPS by 3.9%. However, that revenue it was still 27% year over year growth. And there's not many companies that you can just count on growing 20% plus year after year after year. Shopify has been that amazing product, in that e-commerce space. I've tried a lot of the products. Nothing is as good as Shopify. And their business model allows any company to come in for a low cost, like $30 a month, $40 a month, but they grow with that company. The next couple plans go into $150, $300, $2,000, $3,000. E-commerce, obviously, the world is constantly shifting into that from physical retail to e-commerce. And Shopify has just been the center of that. And you can just see it in the numbers. They're constantly closing deals with huge brands every single quarter. And as I said, there's not many companies that can put up that growth consistently. So, yes, they demand a high forward PE. Sometimes we get up there that is just too high. And that's where you have to be able to run your numbers and run your estimates and see, okay, at this valuation, is there any money to be made in the next 3, 4, 5 years? Sometimes there isn't. And if we get up there, we're not there yet. If we get up there, I would probably look to trim or sell some of that position. Um, at this point, I still see good growth, and sometimes it's just better to hold. Like this is a top quality company. I think it has years of growth ahead, and because we're hitting a short-term peak in valuation, sometimes it's better just to hold. Next up, ASML. Forward P of 28 on this one, 6% weighting. They missed revenue estimates, but that represented 46% year-over-year growth. Now that's coming off a very, very weak quarter last year, so it's kind of, misleading. Their 2-year average growth is 7.1%. They did beat EPS estimates, but not by a whole lot. ASML at 28, the valuation right now is one, the lowest valuation we've seen in a very, very long time. For a high quality company like ASML in the semiconductor industry, most chips are going to go through ASML machines. So it's one of those companies that I think is a top quality company because you how many people know about ASML? How many people know that every device they use, ASML touches the chips in that? Not many. It's just one of those toll booth companies. Their technology is so advanced, they're like 5, 10 years ahead of their competition. Their most advanced technology, their EUV high NA machines, no other company in the world can make them. And at a 4P of 28, it's still low. I could buy more. I'm right around my cost basis on this one too. I could buy more ASML. Um, and if you believe in the future of AI, the electrification of our world, AI being in everything, you're going to need uh, more semiconductors, more advanced semiconductors. If we're slowly moving to renewable energy like solar, guess what? All of those solar panels, those energy grids are going to need semiconductors. ASML is a big part of that process. So, any dip in this, I add and I add, and I expect this to be a part of my portfolio for hopefully decades to come. Next up is Google. Forward P of 19, which is still a joke. Obviously, there's a lot of uncertainty around AI and large language models, ChatGPT, Grok, all those kind of taking market share from Google search. Now, one thing first, none of that is seen in the numbers yet. If you look at their revenue growth, their earnings growth, I mean, Google search business is still growing incredibly fast, like 15% or something. So they beat revenue estimates by 1.15%. They beat earnings estimates by 39%. And that revenue growth represented 12% year-over-year growth. So huge company, still growing incredibly fast. Negativity right now around search. That's why you get this really low valuation. But I mean, I think investors are feeling a little more confident after the latest IO conference. So the price has moved up around $20 in the past couple weeks. And I think that really showed investors that Google, I mean, the company has how many employees, like 170,000 or something. They come up with new products, so many new products and new releases and launches every single year. I do believe they're a leader in AI, and I mean, what they're showcasing clearly shows that they're going to be able to integrate that AI into all of their different products. Their Google search, they're going to be able to improve that. And if you think about something like ChatGPT, um, yes, there's more and more users all the time, but obviously Google still has the majority of the world when it comes to search. If they're able to integrate that into their standard Google search bar, now they have AI mode. If they can bring that to the masses, you know, and kind of be the first point of contact there, like ChatGPT was my first exposure to AI and large language models. So I always gravitate to that. But when you think about the large market share they have with Google search, now that they're integrating those AI products into Google search, all of like that, the people's first exposure is going to be Google. So they're going to be less likely to move away from that. Just like I'm less likely to move away from ChatGPT because I know it, I'm used to it, I like it. So obviously you have Waymo, you have Google Cloud growing at like 30%. They do have other parts of their business that could take over, but then again, Google search isn't really showing any cracks yet. The numbers are still great. You have YouTube, which is often forgotten about. Who rivals YouTube and that type of content? No one. And we're slowly, as a civilization, moving away from traditional media and cable TV to stuff like Netflix and YouTube and podcasts on YouTube. So just an amazing business. It's still a pretty small part of my portfolio, but as I start selling Celsius, maybe I trim Shopify and kind of reallocate those to lower valuations. Google could be a great candidate for me to buy. Um, yeah. Moving on, this is the newest position in my portfolio. United Health. I just made a long video on everything that has happened with United Health in the past year, really since the death of the CEO in December yeah, just go watch that video if you want to learn more about that. Currently has a forward P of 13, just under 2% weight in my portfolio. They missed their revenue estimates and their earnings estimate, and they talk about higher than expected Medicare Advantage plan costs. I talk about why they missed those earnings. But obviously, all this uncertainty with United Health being criminally investigated by the DOJ sounds horrible. Ultimately, after looking at all the news, and as I said, you can go watch that video. I lay it all out. I explain everything that happened. I explain why I came to the conclusion that I'm buying. Ultimately, I determined that most of those issues are short term. This company will make it through that. You see that revenue growth, even after missing estimates, that's 11% year over year. Just, yeah, I would say go watch that video if you want to learn more. I think this honestly is a generational buying opportunity. With that said, though, as I said in that video, I'm taking my time with this one. I'm in no rush. There could be more negativity ahead. If we see some sort of market crash, I could get it at an even better valuation. But essentially, I think I have time to buy this one. And with all the other companies in my portfolio, you know, a lot of them are not at insane valuations. They're still good buys, and they don't have this kind of insane uncertainty like United Health has right now. So I'm just slowly buying week after week. Last company, and I still haven't made this a major position in my portfolio. It's half a share of GXO. GXO is the leader in warehouse automation. They're the first company to deploy humanoid robots into live operations in their industry. They're a third-party logistics contractor. So big companies like Pepsi, um, Michelin, Red Bull will hire this company to manage their warehouses. And they're using robotics and AI to improve the performance and um, the efficiency and the cost efficiency of those. They're constantly closing deals. I think a lot of companies in the future, as they really refine their technology and you know can show cost savings for those companies, they'll pick up more and more contracts. I still, as I said, I haven't started a real position in this yet. There's just so many other companies right now that I'm interested in. And with GXO's business model, very contract based, there's nothing kind of stopping a client from just picking up and leaving and going with another provider, or doing their own warehousing again. So I'm not a huge fan of their business model, even though I really believe in their technology and the efficiency they can bring to that industry. But yeah, we'll see. Maybe I'll increase that position in the next couple of months. So that was the full portfolio. If we look back here at my watch list, obviously the top quality watch list, every company here is constantly on my radar. I always want to buy these. Um, it's just a matter of getting the right pricing for it. As I said, I like value for my money, so I want to make sure I get that. Um, and I think some of these companies that I have been picking in my portfolio have been outperforming some of these just because of the high valuation. Now, I also like these these growth companies that I want to get into. But again, a lot of these, the valuation is just so high. I did buy Robinhood uh, 2 months ago, but the position just kind of got away from me. I was able to get $500 and I sold it a couple days ago because I was already up 55%. And the valuation again was just kind of too high. Now, Meta, I actually don't think they're overvalued. Um, I think Meta's a great buy. I just, for some reason, haven't pulled the trigger there. But that'll be it for this video. If you're interested in learning how I build my portfolio, what I think about, how many positions to hold, what type of companies to buy, and when, look at my pinned or highlighted video on my YouTube um, to learn more about that. See you in the next one.